Hello, I'm Brent Wilsey, and with me is Chase Wilsey. We're from Wilsey Asset Management. And last night, you may have been watching the Academy Awards. There's the Oscars were on last night. Now, there were some surprises there that maybe you didn't know about, and some you did know about, but we're going to show you some that you probably had no clue was going on. And that was the gift bags that the attendees, not the attendees, but the nominees got for being nominated. Impressive. In 2016, these awards totaled $232,000. Gosh, that's hard to get out there. 2015, $168,000. In 2014, more than double since then, $85,000. And again, I want to point out these are not for the winners. These are the nominees just for showing up. Wow. Things they got were incredible. Chase, tell us about it.
A trip to Israel worth about $55,000. A trip to Japan worth about $54,000. I like this one a lot. Unlimited Audi rentals worth $45,000. And then also included in there are some plastic surgery and then a chef meal. You know, the chef will come and cook for you.
You know what's amazing to me? The Audi rentals, I think you could almost buy one for $45,000, let alone rent it for the year.
Yeah, but you can trial a different Audi, so that's pretty fun.
Yeah, that might be behind it, because he's had to have some marketing scheme behind them.
Yeah.
And maybe that's what he's trying to do, is get people to actually buy an Audi, let them rent it. But gosh, that's very expensive, $45,000 for a marketing plan.
Great time to be an actor or an actress. Well, a good one.
Get
nominated for the Oscars.
That's the key. Bad one won't make it. Gotta be a good one. Exactly. So, Buffett, he's now saying to ignore GAAP, and GAAP is generally accepted accounting principles. What's going on here? Well, asset write-down and restructuring, he's saying, well, maybe you shouldn't do that. We've talked about that before. It's about understanding the accounting rules and the numbers makes a big difference.
Yeah, and the one thing you do not want to ignore, though, is stock-based compensation. But Buffett points out and says, keyword here, compensation. Are they being compensated? Yes, so that should be a charge the company takes. But again, he's not saying ignore the GAAP, just understand those numbers.
What I like too is Wall Street analysts are no help here. What's going on? Well, Wall Street analysts are a little bit afraid to say something bad about maybe, and I'm going to name some names here, Google, Netflix, where they don't say anything bad because maybe then they call the company and they're going to say to the analyst, well, sorry, we're not going to give you information because you said bad things about our company. So the analysts really aren't any help here. You got to do your own research and dig into them.
Yeah, and unfortunately the abuse is getting worse year by year. It seems like, you know, that stock-based compensation, more and more companies are starting to back that out.
You know, a lot of people are concerned about a big pull down in the market. I think what could happen is a big pull down will be on these bigger companies that are abusive of these accounting rules because they're so high priced, making no sense.
Yeah, exactly. And again, that's why we do take a look at other things, not just income. We look at cash flow, you know, the assets of the company. So it's so important to understand the company as a whole, understand accounting in general too, so you can really fairly value the business you own.
And let me show you a company that I thought was going to be a good one. I'm kind of very excited about it. Sealed Air. Let me tell you about this company. 52-week high and low, $55 a share, 38. Reported earnings last week. They beat by about, gosh, I think 50%. I think it was 50 cents. It went at 75. The current price on 46. I thought this is going to be a great company. Why? What do? They do something very simple. Packaging company. You ever hear those things that pop all the time? That's Sealed Air. That's what they do. They do all the packaging and stuff like that. But looking deeper at the numbers, I found some things we weren't so happy about.
Yeah, sales were down 9% year over year. Earnings per share, however, were up 35%, so that was a good sign. Profit margin stands at about 5%. However, this was the thing that we just said, oh gosh.
Yeah.
You know, 871% is the debt to equity. We like to stay away from things that are over 100, so that's 8 times 100. That's scary. You know, just not what we like to see. The forward PE currently stands at 16, so right at about 16.5 for the 40-year average. Pretty fairly valued in our opinion, and you know, we're a little concerned that while bubbles are about to pop with that high debt to equity.
Pop the bubbles there, but don't buy this because they're going to pop. And again, just real quick on the debt, it was like about $4.6 billion. The equity was $500 million. But the best thing too I saw, equity's declining. It's down about half over the past year. So not a good company to play with, unfortunately. So if you'd like to know more about investing, want to talk to us about investing, want a free consultation with a fundamental analysis on your portfolio, give me a call at 858-546-4306. Or you can also talk to Chase as well, 858-546-4306. Or go to our website, smartinvesting2000.com.
You know, go to that website right now so you can sign up for our workshop coming up March 19th from 10 a.m. to 12 p.m. And here we'll be analyzing a stock that could potentially be a buy. That company is Qualcomm. We'll be reviewing stock fundamental analysis and why it's successful. And then we'll also be explaining when to buy or sell a stock, and important, going over the 5 common mistakes the average investor makes.
When you attend that seminar, you will be a smart investor when we're done.
Exactly.
Have a great day.